The MACD, or Moving Average Convergence Divergence, is another trend-following indicator. It is one of the better tools in technical analysis, and there are many interesting ways to use it. The MACD is calculated by using 3 different exponential moving averages, and the result is represented by 2 lines that create trading signals. The first line is the MACD line, which is the average of the differences between the 12 and the 26 exponential moving averages. This line is sensitive, so it responds very quickly to changes in price. The second line is the signal line, which is simply a 9 exponential moving average of the MACD line. The result is a slower but more stable line. To simplify, think that the MACD line indicates mass consensus about prices over a short period of time, and the signal line reflects the behavior over a longer period of time. Crossovers of the lines tells us that the balance between buyers and sellers has changed, and in order to trade with the direction of the current momentum, you should trade with the direction of the latest crossover. So when the MACD is rising above the signal line, it means that bulls are now more dominant, and you better trade on the buying side. And whenever it crosses below, it shows us that now bears are in control and it's better to be on the selling side. Now let's learn how you can use these crossovers in a real strategy. Buy when you see that the MACD line is crossing above the signal line. In order to protect yourself, sell in case the price goes down below the recent minor low. When it goes to your direction, sell when the MACD line crosses back below the signal line. To the downside, it's the same. Sell when the MACD goes below the signal line and buy back when it crosses back above. Again, protect yourself by buying back in case the trade goes against you and rise above the recent minor high. In the 18th of April, we have a good example of how it works. The MACD line is the blue one and the signal line is the orange. And here, along with this bullish candle, we can see that the MACD was crossing the signal line from below. This is where we entered the market with a buying order. The recent low area is where we want to protect ourselves in case the trade will go wrong. So if the price will go down, we will exit the position here with a small loss. It's always good to be cautious, so don't expose yourself to big risks. But what we can see is that fortunately the price went up while the MACD line is still above the signal line, all the way till here. At this point we want to close the trade with a nice profit. And now let's see how it works to the downside. Here we have 2 great selling trades. The first one is here. The MACD is crossing the signal line from above to the downside. This is where we want to sell. Our protective stop loss level will be placed here above the recent high. Then, as you see, the price is dropping, and we buy back here when an opposite crossover takes place. And then again here, a downward crossover. The MACD then tried to cross back but failed. And it was only here that it was able to cross back after this nice line. This is where we close our position by buying back and enjoy additional profits.